Good morning and welcome everyone. Thanks for joining us. I'm John Orchard, OnFIF's CEO, and we're really delighted to have you with us. It's quite a crowd we've got today for this ING DMI digital forum on central bank digital currencies and their significance for commercial banking. It's an enormously important theme, as we'll see. Firstly, a quick bit of housekeeping. This isn't a Chatham House rule meeting. It's on the record. Indeed, it is being recorded. And it's also live streaming on YouTube. So welcome to you there as well. Our partners for this session, ING, will open in just a moment, and then I'll share a panel discussion where your audience questions are very much welcomed. Please use the chat functions on your viewer platform. My colleagues are showing you where that is just now. And we'll curate and put those questions in the course of the session. We're very keen that you send them in. We've got a lot to discuss, so without further ado, I'd like to hand over to Mark Cliff, Global Head of the New Horizons Hub, which is ING's research and thought leadership unit, and looks at consumer behavior, digital innovation, sustainability, and geopolitics. Mark, over to you.
Thanks, John. Well, on behalf of ING, I would also like to welcome you all to this ING DMI Digital Forum. As John mentioned, digital innovation is one of the priority topics of the ING's New Horizons Hub. We call it a hub because we're not just using our own internal expertise, we're trying to work with top experts externally as well. And that's why we jumped at the chance of joining as a founder member of the Digital Monetary Institute that OnFIF has recently created. ING, of course, prides itself on being a digitally savvy bank. And so the emergence of digital currencies is of huge interest to us. But what we've found is that in this field, there's a lot of attention being paid to the technology and to the policy issues, and to a certain extent also to the questions of financial stability. But there's remarkably little attention being paid so far to the impact on the banks themselves. And we've made a start on addressing this through our collaboration with the DMI. In fact, in June, in the DMI's own journal, we published an article which set out some of the issues. And it's clear that central bank digital currencies could have a profound impact on the bank's business models, profitability, and balance sheets. So we're very happy about the timing of this forum, because it does look as if we are getting very close to the central bank digital currencies becoming a reality in China and possibly in some places in Europe. And we clearly have a great lineup of speakers, thanks to the support of the DMI in setting this up. So I'm looking forward to the speakers addressing these issues in more detail. So without further ado, I'm going to begin by introducing Mark Boutenhek, who will make a few introductory remarks. He is ING's Global Head of Transactions Services. He's spent over 25 years in the payments business and digital channels in different roles, ranging from product development through to sales and operations. And he's been involved in many international initiatives to make payments faster, easier, and cheaper. He's the founding father of Ideal, which is the dominant e-commerce payments method in the Netherlands. He's the sponsor of the GPI, which is a new product of SWIFT, which enables international payments to be made within minutes. And he's made instant payments the norm in ING itself. And on top of all of that, he's a board member of SWIFT, MasterCard, Payconic, and DLT-based Trade IX. So Mark certainly has an intense interest in the potential impact of central bank digital currencies. And so I'd like to give him the virtual floor. Over to you, Mark.
So thank you very much, Mark. You would wonder if I still have time to do my work. The good thing is this is a huge part of my work, and I'm really pleased to be here. Without further ado, I'm really pleased to be here in this panel. And if one thing is clear, if you look at what we're talking and discussing about today, is that we tend to get used to things going fast. it may be an old thing, but the iPhone was introduced only 13 years ago and has completely changed our lives. And maybe to all of us here operating from our home environment, does it really feel just 7 months ago that you sat in a bar, not worried about the proximity to other people? And similarly, just 2 years ago, central bank digital currency in most countries was a complete niche concept, only discussed by so-called monetary geeks, mostly found in central banks and silent corners of university buildings. So fast forward now to 2020, and CBDC is becoming boardroom material. It features prominently on the agenda of policymakers, central bankers, and bank CEOs. And there's not a single development responsible for this remarkable evolution of CBDC. Instead, there are a number of factors that came together, and I'm sure the audience here knows much more about it, but let me try to phrase them one by one. So first of all, the longer running declining use of physical cash, of course, prompting central banks all over the world to think about the role of public money in a digital world. And by the way, their own role as well. In the panel, we have a central banker from the Riksbank on the panel, and it has been on their agenda for quite some time. The same goes, by the way, for the People's Bank of China, that has been planning the transition to a cashless society for a long time. And when China is looking into this, everybody pays attention these days. The emergence of new digital tools that might facilitate the introduction of new digital currencies. I'm here talking about blockchain, DLT, obviously, and Dave Birch, I will not go into the detail because you will probably hit me there on the head. That's the second point that enables this. And maybe the one that has dramatically sped up this whole discussion within let's say the public domain and the commercial domain, as well as the announcement of Libra, the first private digital currency with a credible claim to world adoption and disruption of the whole remittances market. It's credible and therefore potentially threatening for maybe for financial stability, but at least monetary autonomy. To this, you could add a geopolitical element. I mentioned already China, but both Libra and the Chinese ventures into digital currencies have woken up to the world, to the strategic importance of currencies and payment infrastructure. This, I think, has helped turning CBDC from a technical issue into a political topic as well. Then, so those are the four key things I think that have driven this interest on CBDC in general and put it higher on the agenda. As a banker, I've become used to innovation being a two-edged sword. On the one hand, innovations offer, of course, new opportunities to explore, and you should never ignore that. But on the other hand, they might cannibalize an existing business. And sometimes it's better to cannibalize your own business before somebody else does it. But it's no different for CBDC. It might offer new opportunities for banks to interact with customers, but the potential downside is also substantial. The availability and stability of our deposit funding is what is at stake or could be at stake. Moreover, how does CBDC as a separate and new infrastructure relate to the existing payment infrastructure, including the new investments made therein? I didn't mention even the European Payments Initiative that is currently going on. Or should it become a hybrid model like MasterCard suggested last week when they kindly offered their sandbox environment to central banks? Clearly, CBDC raises a lot of questions for banks. So I think we are having a discussion about this at the very right time. One last point I would like to make. We all tend to overestimate the speed of change and we all tend to underestimate the impact. And that's what we're talking about here. So with that, I'm going to hand over back to our moderator of today, John Orchard. So thank you very much and have a good conversation.
Thank you, Mark. That sets the scene very well indeed. And thank you also to ING for helping facilitate this discussion. We appreciate it. very much. Now to introduce our excellent panelists. We've got Hannah Armelius. She is Senior Advisor on Payments at the Analysis and Policy Division of the Swedish Riksbank. We have Toinis Brosens, Lead Economist for Digital Finance and Regulation at ING. And we also have Henry Arslanian, the FinTech and Crypto Leader for Asia at PwC in Hong Kong. And we have David Birch, who's an author, advisor and commentator on digital financial services. He leads 15MB Limited, is Global Ambassador for Consult Hyperion, and is Technology Fellow at the Centre for the Study of Financial Innovation, and a visiting professor at the University of Surrey Business School. So David is a busy man and has plenty to say, as we'll discover. So thank you very much, panelists, for joining us, and thank you to the audience again for listening in. Very important themes, as we've just heard. Before I get into the questions, I've got a very quick poll that we're going to run, and we're going to do it now and then again at the end to see if minds changed. So Sasha, could you put up our poll question, please? And if everyone could vote. And do we have the results yet, Sasha? We could put those on the screen. So enormous amount of optimism and not too much risk. So we'll explore that throughout the panel and see if people think the same at the end. So despite that, the overwhelming optimism there, I want to have a high-level whiz round the first principles of the risks. People often talk about central banks as managers of the economy through their control of the price and availability of money. The institutions actually creating the money, of course, setting aside capital markets for a moment, are commercial banks, and they do so through a complex, heavily regulated and leveraged process that most people don't understand or already know about, certainly in the retail population. On that basis, Toinis, could we explore quickly the high-level risks to commercial banks then of CBDC? And we know that central banks working groups are doing just that. Let's assume for now that those risks aren't yet offset by design features. We'll look at those later. What happens then if there's a digital version of cash on an app directly issued by central banks? What happens to deposits in commercial banks, and why is that an issue?
Maybe just you just said money creation is a very complicated process. Although if you look within the bank, then and even if you just ask our people making loans, then first they often don't understand that they are creating money. But it's really not that difficult. The loan is put into the computer and the money, poof, is created at the same time. It's really, but conceptually it's difficult indeed. Now about the risks, I must say I was a bit surprised by the results of the poll. And full disclosure, I voted no. Maybe you would expect a banker like me to vote no, to say, well, maybe the risks currently outweigh the benefits. And I'm not saying that CBDC might not have benefits. I think there certainly are benefits. And arguably, you could even say that CBDC will in the future arrive. I think we are with the declining use of cash, that there will, some decades ahead, probably CBDC will be everywhere. But currently, I think with the current ideas floating around, the current setups that are being discussed, I think the risks are still major. And I think they are well known, so I will not elaborate a long time on them. But I think the prime risks is the availability and the stability of the deposit base of commercial banks. Because for commercial banks, deposits are the largest source of funding. They are a very stable source of funding, and banks use this funding indeed to make loans. And CBDC could imply that indeed this deposit base becomes more volatile as people, it becomes easier for people to switch between commercial bank deposits and CBDC. And especially, of course, in crisis times, in difficult times, this deposit base could even vanish, which makes it very difficult to plan ahead for a bank and to plan balance sheet developments, to plan liquidity and capital if you're not sure about the availability of deposits. And well, maybe we can go into that later on a bit deeper. There are some mitigations or solutions being presented about how can we make sure that CBDC will not take away all these deposits. But for every potential solution that's presented, I think it's not fully, it doesn't work fully, and there are still some problems with it. So that's the one problem, the balance sheet problem. And the other problem, which is both a problem and an opportunity, is indeed the challenge to the bank's business model. And the commercial bank is currently basically for clients, for the population, the gate to to money and to finance. Payment accounts are mostly kept with banks. And that might change because when you move to a world of CBDC, then CBDC might be offered by central banks themselves, by non-bank service providers. So yeah, that's definitely a challenge for a bank's business model. Although I think this business model challenge is actually, from a societal perspective, maybe a good development because it brings more diversity, it brings more innovation, and it challenges banks to indeed also to innovate and to provide better services to their clients.
Okay, thank you, Thijs. I just want to explore the balance sheet problem a little bit further before we move on to some of the other issues. We slightly forget about the magic of fractional reserve banking. I mean, some of the early discussions about CBDC somewhat envisaged what might be called Vollgeld in Switzerland, where you'd have loans and deposits matching one another at some fintech company. We forget about fractional reserve banking as a huge source of credit creation. Henry, can you help us understand that before we move on, please?
Sure. Sorry, they were just cleaning my my garbage. Now, first of all, I think just on that point, I think the survey results would have been very different. We changed commercial bank with financial stability. And also just to answer Antonio's question, I think if we ask the same question to the broader public, I think they'll, as long as they have banking services in a nice, enjoyable, with good user experience, frankly, they wouldn't care if it's coming from big tech or commercial banks. I think it brings up a lot of interesting questions from that perspective. Maybe a couple things I would mention on the risk element as well. Maybe just put my professor hat on for a second. I think in addition to the ones that Tony's mentioned, also I think the big one from a policy perspective that probably the public cares more about is really the event of accelerating of a bank run in the event of financial stability. You know, for example, when I talk about this to my students or to a layman, obviously here today we have a very knowledgeable audience. All of you are listening to this, but to the average person, you know, it's like if today I don't trust the banks anymore, I could go to an ATM, withdraw all my money in cash, and try to hide it somewhere in my office or my home. There's obviously security concerns. There's practical issues with that. Whereas actually with a CBDC, I can probably do that very quickly, easily on a digital wallet. This is why I think a lot of the proposals that we've seen so far, including the Netherlands and others, where they're trying to put a limit potentially of how much CBDC I can put in from within a digital wallet if I have one. So I think these are some of the things to consider. On the banking side as well, John, I think one thing to bear in mind is that we've had this discussion before in the fintech world. You know, 2-3 years ago, when big tech was coming, was the fintech startups were going to come and disrupt the banks. Frankly, overall, when we look at it, the net impact has been actually quite positive. I mean, I can just look at the market where I'm physically. I just got back to Hong Kong. I just finished my 2-week mandatory quarantine in a hotel room where I was not allowed to leave. And one thing, for example, now there's 8 new digital banks launching in a small market here that's 95% banked. And literally this week, as new banks have launched, a lot of the traditional banks, commercial banks, have reduced their fees. Suddenly, the fees have come down, the service have been better, and a lot of that have been improving. So we had this discussion. The 2 challenges that we've seen, I would say, in practice, one of them is often how do you plug it with the legacy infrastructure, which, as we know, is very, very difficult. So whether the debate of do we start a complete new entity, and actually that may potentially accommodate this CBDC discussion or development that we can have. I'm sure we can talk about that later. But also, I think there's human element as well that we should not consider. We should consider as well. For example, one thing we saw with fintech, and again, I think it's very important for we make the analogy, the same questions we had it in a fintech context 2-3 years ago.
Do you mean on the peer-to-peer lending platforms and things like that, Henry?
Even more than that. I mean, think about from anything from RegTech, regulatory technology, to lending and others, because the reason is often there's a career risk as well. If anybody who's worked in a bank here knows any kind of technology deployment, especially in the spaghetti of a bank, is very dangerous, and there's a big career risk. And frankly, when it comes to CBDC, the real impact, nobody who's working right now in a senior position in the bank will see the P&L impact in their career. This is a problem we'll see in 5-10 years, which is very likely many people in decision-making power here will be already gone. So I think that's one thing. There's a career risk element as well we have to consider. So again, I think there's a lot of lessons we have learned from the fintech world. And frankly, generally speaking, we've seen big tech play a big role. Fintech has had a very positive impact. And the question is whether CBDC can have the same thing. So yes, we look at the risks on commercial banks, but we need to consider the broader picture.
But Henry, I'd like to go to the central bank president in a minute to talk about this. But you're not unduly concerned about defunding commercial banks through the flight of retail deposits, especially in a crisis where there are runs on banks. That's not something that concerns you.
No, for two reasons. One of them is actually from a policy-making perspective as a central bank, and to all the central bankers in the room, from a policy design, and I'm sure we talk about design models, a two-tier system and others, we can put the right safeguards from a financial stability perspective, preserve that. So for example, the capital flight issue that I was mentioning before, that people can have their CBDC on their CBDC wallet, we can put certain restrictions on it. I mean, one of them is an amount you can keep, which was discussed in the Dutch proposal, or second is the interest rate with programmable money, that I can potentially have a different interest rate for my account-based money traditional in a fractional banking model that I have with my lovely bank, and a different one or reduced one potentially with a CBDC wallet that I may hold as well. So there's an incentive of people to actually still keep their money in the bank. And these are tools that our central bankers will continue to have. That's not going to disappear tomorrow morning.
And we certainly hear about that in the working groups. Hannah, I think it's a good time to go over to you. Scandinavia, as we know, is somewhat in the vanguard of countries moving away from physical cash. You've also had negative interest rates there, and I want to come in onto the interaction between these two things a bit later, as we've done some research on that. How do you regard the risk to the commercial banking sector of central bank digital currency? The retail population probably wouldn't be able to tell the difference, but the time when they would tell is probably in a financial crisis, when they're likely to want to have a deposit with the central bank and not with a private sector financial institution at risk. What's your view on those themes and how to deal with them from a regulators and central banks point of view?
Thank you. Thank you for inviting me to this panel. I just wanted to start out by saying that I work at the Riksbank and I'm involved with the e-krona project. I think I'm probably one of these like monetary geeks that were mentioned before. But I just wanted to mention that everything that I say, I mean, the Riksbank does not have an official view on everything. So my views that I express here will be like my personal views and should not be interpreted as representing the executive board. But I will try to convey what the thoughts are at the central bank at the moment. Okay, so when it comes to the bank's business models and the impact on the financial system of a CBDC, I think that everything that has been said here is correct. I mean, potentially the impact could be very large. But central banks have a mandate to maintain financial stability, which is something that we take very seriously, of course. So I think no central bank would implement something that had like a very disruptive impact on the financial system. So as far as the Riksbank is concerned, we view it more like maybe the revolutionary thing for the financial system would be if the central bank presence for the general public, like in the payment market for the general public, would not be there anymore. I mean, if we go into a cashless society and we don't have any CBDC, then that's sort of a new system. If we just maintain some sort of small presence, then that would be sort of like maintaining the old model and the roles that the central bank and the commercial banks have been playing. but just that the form of the central bank money would be digital. It would not be physical anymore. So it's more like adapting the role of the central bank to a digital future, but not with the aim of introducing something new, disruptive, really revolutionary in that sense. So yes, we do have to think about it, because we don't want to end up in the solution where banks' business models are threatened. But like was said before, I mean, that can be mitigated by just many different tools. And so what we're trying to achieve, I think, is more like maintaining the old system instead of creating something new and revolutionary. But that is something that really has to be designed carefully so that we achieve that goal.
Okay, thank you, Helen. So I think for now we can set aside the idea that central banks would allow the commercial banking sector to be unduly disrupted or defunded by the introduction of CBDC, including in crises. No doubt that theme will come back. David, I'd be interested in your perspective. You've followed this area for years. Are you worried that a botched implementation of CBDC could damage commercial banks? I don't think you're unduly worried about that. What's your view?
I think a botched implementation of CBDC could damage everything. I mean, I don't think it would be particularly so, but if we assume that it's not going to be botched, so let's imagine that the CBDC is built by, people like Hannah and Tunis and not management consultants, and we have a working implementation of it. I can't imagine any central bank or any regulator anywhere allowing what we will refer to as the single tier, what Dowie has just talked about in the chat channel. So yes, you could imagine a situation where the central bank effectively just, does something like M-Pesa. You have, everybody has an account at the central bank. And if I want to send money to you, I do it by just like Hotmail or something. It would be the central bank do they still have Hotmail, or is that gone? Or Google Mail, for example, for the youngsters. So it would just be like you log in, you try and get Dave Birch. Dave Birch is gone. So you get Dave Birch 1234. And now you've got an account. And now when you want to send money to me, you just do it like that. And the marginal cost of the implementation of central bank digital currency and all of the transactions would be negligible. They would be immeasurably small. I mean, so that is clearly the cheapest and simplest way to do it. It will never happen. And the reason for that is I'm convinced that the problem of funding central banks is just too great for the central banks to tackle. So, perhaps in another jurisdiction, somebody is saying we're going to revolutionize the financial sector. We're fed up with the banks. The cost of financial intermediation has been essentially unchanged for the last 100 years. The senile oligarchy of banks extracts way above market rents from a marketplace that it doesn't serve very well. And so we're just going to stop. We're going to stop allowing banks the privilege of credit creation. We're going to have a central bank digital currency. And if banks want to exist, then they'll have to find something useful to do that they can earn fees from. The private seigniorage on credit issue, which I think Tunis probably knows these figures better than I do, but I think in the Eurozone, it's about €1 trillion per annum in private seigniorage.
David, just on that point, if we were to go down that, well, we're not going to go down that model. If we did,
no, I can't see it happening. I just
where would the leverage come from? So the leverage that's implicit in the commercial banking sector would then need to move to tech companies or the central bank itself, which seems
it would be the
possible,
it would be the central bank itself, I'm sure.
Yeah.
But as I say, I think that's hypothetical. I don't think that's going to happen. I don't think any central bank, certainly not in Sweden, not in the Netherlands, not at the Eurozone. No central bank wants that to happen. So what they will do, I'm sure, is what the Chinese have done, which is the central bank will control the currency and it will set the limits on how much, and it will make the banks hold appropriate reserves, et cetera, et cetera. But actually it will be the commercial banks and other players, we might come on to that later on. It will be the commercial banks that provide the CBDC to the general public. I'm happy to listen to other evidence, but personally, I can't see any alternative to that at the moment. And you may say I'm very conservative, but I think that's the reality of what the regulators see.
So on that basis, do you think it's unlikely that payment platforms without leverage would displace commercial banks as principal financial intermediaries in the retail economy?
Financial intermediaries for payments? I think you have to say that, I mean, I don't want to tread on economists' toes here, but if you look at the literature, the reasons why banks are so dominant in the payment space are not obvious. If anything, it's a historical accident. The provision of credit and the provision of payment services have become jumbled together because it was convenient during the Industrial Revolution. But there's no inherent economic principle that says those two things should be together. So I can easily see a situation where technology allows us to unbundle those things effectively, and you have what the Bank of England have taken to calling PIPs, payment infrastructure. Wait a minute, I've now forgotten what that is. PIPs, payment intermediary providers or something. So you'll have those, and that will become separate from the business of credit creation and the other risk management information functions that banks provide into the economy.
Okay. If I may answer to that, John.
Please do come in.
Yeah, because I fully agree that it's no law of nature that banks are as they are today, and that a bank combines lending, or that as a society we have combined payments, saving, and borrowing into one institution. I mean, that's indeed it's a coincidental outcome of historical choices made with no strategic plan beforehand. This is just the result of history as it played out.
Yeah, I agree.
I fully agree with that. At the same time, we are where we are with a big role for banks in the financial sector, in the economy. And it is true that that CBDC offers a great opportunity to rethink the fundamentals of our monetary system and to think about, well, many different ways in which you could build that financial system, including many ways in how you could fund credit. And that's I think a very good exercise, because it forces us all to reconsider the roles that the various institutions play in society. But the second part of that is once you converge on an idea about how you want the fundamentals to look like in a decade or 2 or 3, then there is a huge question: how do you transition from where we are today, this accidental outcome of history, to where you want to be? And it's this transition where you have to pay attention to financial stability issues and to the funding of banks, not because you want to preserve the banks, but because you want to preserve financial stability, and you have to manage this transition properly, and you want to avoid accidents along the way.
I agree that I understand, but to go back to Hannah's point about, I mean, I'm possibly reading between the lines a little to what Hannah said, but we're in a situation at the moment where there is no strategy. So consequently, in some countries like Sweden, we've had, I wouldn't say accidental, but we've sort of slid into cashlessness, without an actual strategy towards cashlessness. And that's resulted in a suboptimal situation. Fighting to retain cash, as in the UK, is also a suboptimal situation because it requires significant cross subsidies. So I agree with you. The place to begin is by saying, well, what is the strategy? And the strategy, I would assume, depends on some very non-technological factors, because it's inclusion, it's stability, it's reduced friction. But if without setting those exactly, if we all sort of share the general vision that in a decade from now, we want Europe, you want Europe to be a place where there's lower friction in financial transactions, where there is stability, where there's more financial inclusion. A CBDC would be a pretty good way of moving towards that, because a CBDC I kind of agree with the Bank of England's view on this, and not just because I'm English, but their view was, on the one hand, you have the cost savings, and we can all understand that, but the real benefits from a CBDC come on the innovation side. It comes from creating a platform for new products and services and new ways of doing business. And that could be pretty substantial. So, I mean, I wasn't joking in the chat channel. I mean, you could say, what is the point of spending all this money on Pepsi or EPI, it's like, it's kind of EMV all over again. It's in the last generation, we created the best offline payment system in the entire world at the exact moment the entire world went online. And there's a mismatch. We could construct something that uses central bank digital currency plus a pan-European 222 request to pay infrastructure to build something that's far cheaper and much more reliable than interconnecting the existing system. So if we sort of roughly agree on what those end goals would be, and I'm sure we do, we all want those same things, then actually a central bank digital currency is a pretty good way of getting there. But to take your points on board, we are where we are. So that central bank digital currency will inevitably be issued through central banks and other payment institutions.
David, thank you. I just want to go back to explore an interesting concept. We were talking earlier about the risks involved to the commercial banking sector in a central bank digital currency. One of the people in the chat room, Otta Godza, has asked about interest-bearing CBDC. Hannah, from your point of view, I know that the People's Bank of China, which seems furthest ahead on all this, they would lean against people trying to deposit money with the central bank, certainly beyond a particular amount, and would use interest rates to push people back towards the commercial banking sector for all the reasons we've discussed. What's your view on that? Would you have an interest-bearing CBDC? Or if you do, would it be at a discount to the one that's available in commercial banks?
Well, I think we haven't really taken a decision on that yet. We are not at the point of implementing an e-krona. So what we have said in the procurement that we have made for our pilot project was that we want at least the option, I mean, technically speaking, to be able to put an interest rate on it, perhaps in the future. So I think most central banks are looking into CBDCs without an interest rate at this moment, I think. But maybe more central banks are feeling that, perhaps in the future, like if it could, for instance, be a tool to curb a possible run into CBDC. As was mentioned before, we could envision something like allowing people to have a zero interest rate CBDC for like transactional purposes, but then have negative interest rates if you see a run starting and people want to transfer large amounts or something like that. I mean, it's just maybe not a very good idea to just rule it out completely from the beginning. But I don't think anyone has taken a decision.
In other words, you could use that mechanism to solve the problem that we've raised. You could disincentivize runs on banks through interest rates.
It's one possible tool because, I mean, you could also have caps or limits, but if you do for a long time, there's always, I mean, a possibility. If you try to put limits and you have the wrong pricing, maybe there could be like incentives for people to set up, I don't know, false identities or start companies so that you can have another, chunk of CBDC. If you use the price on something, then it's an easy way of getting like a correct demand.
Just a final point on the bank runs issue, and then I want to go through two other key themes in particular before we move on, which is the issue of identity. Banks have a huge infrastructure on that already, and transaction services and so forth, the integration of these technologies across financial services. Before I do, on the bank run point, Hannah, if you think of a society that tends to favor cash a bit. Let's take Germany, where people might put money under the bed, say, apocryphally. If cash were not available, where do you think that would go? Do you think people would buy gold instead? Where would conservative people try to put their money if they wanted to, if they totally lost faith or almost completely lost faith in the financial system?
Can I make one tiny point about that before Hannah answers?
Yeah, all right, Dave, go on, and then I'll go back to Hannah. Thank you.
One tiny data point, which is that according to the Bundesbank's official figures, almost all of the cash that's produced in Germany is never used. It's not occasionally used. It's never used. It goes directly into stashes and hoards. I just want to introduce that data point before the answer.
Okay, thanks, David. Hannah, let's say CBDC in the Eurozone means that's essentially impossible. Do you think they'll simply throw in the towel and put the money in the bank, or will they buy gold or something? What do you think?
I don't really know what people would do, but I mean, just a few points on the possibilities of a run. I think, first of all, like you said, it would have to be like a systemic run, because you can easily run from one bank to another. And of course, you have a lot of banks in Europe. So that would mean that you would have to want to run from all of them. And then do you want an alternative? I mean, I think there are other things you can do. You can run into some, other currencies or other government bonds. And we also know that runs are primarily not done by the people on the street, but in like the wholesale sector. So it's an important issue, but we also, there are a lot of things that you can sort of think about here. And also from a central bank perspective, I also think that if people really want to have a safe government alternative, is it right to not offer it to them? I mean, if the whole banking system is under pressure, we serve the people, not the banks primarily, right? So it's a complicated issue, I think.
If I may add to this.
Please, Tonis, do come in.
Yeah, because indeed bank runs can be wholesale, but also retail. I think we all remember the long lines for Northern Rock ATMs. What was it, 10, 12 years ago? And the problem is, yes, bank runs are possible right now. It's you can take out your money through an ATM, you can transfer it to another bank. So you could argue that nothing changes when CBDC is available. But it does change because it becomes a lot easier to transfer your money out of a bank into a CBDC. And that is, I think, the problem. And again, this is a transitional issue. I mean, this is not an issue that should block any thinking about CBDC. It's an issue that we need some solution for, because a bank run becomes easier. So it's a real and present danger. And I also think that the solutions that we also discussed now on the panel, imposing caps on CBDC holdings or interest rates to discourage holdings, they work fine in normal times, in peace times, so to say. But we all know that in crisis times, then of course still the central bank will want to keep these limits as they are. However, political pressure will mount, and political pressure on the central bank to accommodate people's desire to perhaps move out of banks and move to what is then considered a safe haven.
As Hannah just described, it may be considered a duty for state institutions to do that.
Exactly, and this is not something that you can manage with rules. This is political pressure, and well, how are you going to withstand that? And I don't think the framework is up to that.
Yeah, the thinking's not finished yet. Henry, should we spend a little bit of time perhaps talking about the PBOC's plans on CBDCs? They seem to have thought quite a lot about all of this. Their plans, as far as I understand them, are designed to prevent a private sector duopoly in the payments system more than anything else. You want to talk a little bit about their practical answers to this? They seem to be closest to implementing, and then we'll go on to identity and tech.
No, absolutely. I think, well, if you look at the broader even fintech world, China is a couple of years, I would say 4 to 6 years ahead of the rest of the world. In certain areas, like insurtech, China is probably a decade ahead of the rest of the world. When it comes to the future of money or the conversation around the broader, let's call it digital asset space, China on this topic is probably ahead as well. I mean, just a bit of background, the PBOC has been researching this topic since 2014, where we're having great research papers, experiments, consultations from many other countries, and small deployments maybe in the Caribbean and other places. I mean, in China, it's completely at a different level. By the way, this is not only a CBDC issue, it's also on the broader blockchain and crypto space as well. Asia, I would argue in many regards, is probably in a crypto space 6 to 12 months ahead of what's happening ahead of the world. A couple of things, obviously, which is very interesting from a China perspective, I think for everybody to realize, is also, I mean, China is practically right now cashless already. I used to live and study in China, and now when I go back to China, because I don't have a bank account in China, I'm practically unbanked. I'm literally the annoying guy to try to pay in cash, and you're the one gets the bad looks and gets insults from everybody, right? So I think that's one thing, that there is a very practical problem right now with tourists and actually business people traveling to mainland China. If you don't have a bank, you don't have a Chinese bank account to which your Alipay or WeChat Pay is linked to. I think a couple of things, the proposals they've done is actually closed network. It's a M0 level. Obviously, there's no interest bearing, like Hannah and others just discussed a couple of minutes ago. But also, I would say that at the pilot level as well, now it's the initial wave. This was going to be piloted in 4 interesting cities: Shenzhen, which is the Silicon Valley of China. It was happening in Chengdu, which is the Panda City, if you want, in Sichuan, in Suzhou on the east, and also in about an hour away from Beijing. So these are not little theoretical pilots. These are not really academic questions. These are actually moving ahead. There's a lot of policy reasons there, which I guess many of you are familiar with, from not only giving people option, the better payments, but also there's practical reasons. Like, one of them that I often love to give, I really believe that CBDCs, for the first time in a very long time, give us a fighting chance against money laundering, for example. Today, again, if you want to buy drugs or commit a crime, cash is still probably the most private and best way to do so. But actually with CBDCs, we get actually fighting chance to tackle this problem, which, all you guys know, is 5 to 7% of global GDP. It's a big issue. So again, I don't say we're going to be able to solve it, but I think from a policy perspective, it helps us address potentially that issue as well. So I think from that perspective, China on CBDC, Asia on crypto, again, way ahead of a lot of issues. I think, and this is why it's going to be interesting for a lot of policymakers to look at what's happening in China as we think about our different models around the world.
Thank you, Henry. On money laundering so far, that leads actually into a huge discussion about anonymity and so on, which I don't want to spend too much time on here, as we want to focus on commercial banks. I've had a very interesting question in from someone watching on YouTube, which is what the business case would be for commercial banks to invest in distributing CBDC. That's an interesting question. I think also leads on to something David's got to say on using this existing infrastructure that banks have since they're regulated to solve some of the issues we've just talked about. So, Toinis, what would be the business case for an institution? You don't speak for ING in this form, but what would be in it for ING to distribute CBDC?
Well, especially in the platform economy that we're moving to, having as a company the primary relationship with a customer is key, because from that position, the customer best. You have, when the customer allows, you can have access to his data, you can make customized offers. So this is really the place that everyone wants to be, and that every platform wants to be, and also that banks would like to be. If indeed a CBDC would take the form of a hybrid structure where commercial banks and other non-bank providers, because I don't doubt that we are moving in that direction, and that commercial parties can provide CBDCs or are basically the sole providers of CBDCs, then indeed also banks will be able to offer CBDC services and will be able to integrate those services into the other financial services that they are offering, into the platform that they are trying to build, and so in that way, retain the primary customer relationship, because this is
no different from a cash point machine. It means a cost to you to provide them, but maybe you'll be able to advertise your mortgages at the point of distribution.
Well, I mean, that's one way. I mean, and currently, of course, banks ask money for payment accounts. So that's a direct fee that banks have, and that might or might not remain in the CBDC world, because, well, the costs of CBDC and who bears them is another discussion. But indeed, the access to the client, that's what this is about, and this is, of course, what's going on anyway. Also, aside from CBDC, the whole competition with the big techs, with fintechs, is all about who has access to the customer, and I think CBDC intensifies this competition.
Okay, I've just had a very interesting question in on China, just before we move on from China. Andrew World from New York Media, he's asking, do you believe that regulators will allow their nation's banks to work with China's DCEP, their digital currency, if governments are concerned about Huawei in their telecom infrastructure, how are they going to feel about the PBOC software moving across their systems? And we've got to run into issues of interoperability and all the rest of it as well. But what do we think specifically on this geopolitical issue? Perhaps to you first, Henry, on that one.
Yeah, no, it's a question comes up a lot. I would say, frankly, when I look at a lot of these CBDC initiatives, not only China, but others, I have trouble seeing how this could be at a cross-border level at the start. Definitely not. I think a lot of the CBDC initiatives at a country level, I think that's what also the DCP will be aiming to do as well. I think there's a lot of the best use case for, frankly, the DCP is actually not a global level. It's really what's happening with One Belt, One Road, where you have dozens of countries, a lot of trade going on, often right now in US dollar, when actually this could be an interesting alternative. The one thing I would say on a cross-border level that I think is becoming very interesting, especially if you look at the Asia and West element right now, is you're already seeing it with stablecoins. With the stablecoins, digital assets that are backed by fiat currencies, a bit actually the model that the Libra Association is trying to do as well. Those volumes are really going up month on month. We're at record levels now for the last couple of months of stable coin usage. So I would expect actually what I'm watching at the national level is the CBDC initiatives, but I would say at a cross-border level, I'm watching more closely what's happening with stable coins as well among various initiatives like Libra, for example. So I think that's really the issue. So I'm not sure there's obviously a geopolitical race on this topic, and which is I think going to be very interesting. But on a practical level, I'm not sure there'll be that much of an impact. Okay, thanks. We're getting some questions on technology, and I'll come back to that later. So I want, again, just to go back to commercial.
Can I just
please, David,
add one thing to what Henry said? So I've put it down. I had it in my hand a few minutes ago, and I don't know what I've done with it, but I was just reading a paper. There's a Federal Reserve paper from earlier this year, Federal Reserve Board, a detailed simulation of what they incorrectly, in my opinion, call stable coins, because what they're really talking about is currency boards, because it has a 100% reserve in fiat currency. There are no other assets in it. But they were modeling Mark Carney's synthetic hegemonic currency as a currency board with a defined basket. And the simulation results showed that actually the demand for holding such a coin is actually quite limited. It provides other sort of functions, but its mere existence would increase the net welfare throughout the economies where it was available. So in other words, the fact that nobody would actually use Libra, but the fact that Libra existed would constrain the activities of some jurisdictions. So in other words, even though the holdings of that basket, the holdings of that stable coin, I hate that word, the holdings of that would be very limited. That does not mean it wouldn't have a very important positive impact. I'll find the paper. I don't know what I just did with it. Hold on.
Okay, thank you. Just to explore the technology and then relate it back into transaction services and the payments infrastructure in banks. Hannah, you're looking at this. What technology do you expect to emerge? And how will it deal with interoperability, and how will it dovetail with the payments infrastructure within commercial banking as well? What are you seeing? What are the solutions so far?
I think maybe it's a bit too early to tell, because certainly a lot of piloting and experimenting is going on with DLT technology, but I don't think that that has to be the technology for a CBDC, because it's also something that central banks, I think, want to learn about the technology and know more about it, but that doesn't necessarily mean that that's the only option for a CBDC. And with interoperability, I think, well, we are learning as central banks also that, with the RTGS systems that we built, we only had a domestic focus. So maybe if we build something new, we might want to take some, cross-border aspects into considerations. But I think most central banks are primarily concerned with the domestic part of the CBDC. I personally think that, you know, what happened with cash was that our technology became sort of old and not wanted by the public anymore. So it would be good if we could just not lock ourselves into a new technology if we launch a CBDC, because we don't want to end up in the same situation again. I mean, I think the most important part is to have the concept of central bank money that's available to the general public. And then perhaps with a two-tier system, the central bank doesn't have to be so decisive in what technology is used, like in the customer to the customers. Maybe it's better to just let the private market innovate and handle that part.
On that, we had in the UK an experiment, I suppose, with Oyster cards. You'll have probably used that. And it's quite an interesting exercise. No one uses them anymore. It just went straight to straight onto people's phones, where Google and Apple have become the intermediaries. So you could argue here that already in this country, in London, CBDC was displaced by an American tech duopoly. Are you concerned about that?
We had something in the 1990s called the cash card in Sweden. That was provided by the commercial banks, but it never really took off. So people sometimes say that, you know, a CBDC would be like a cash card, and it would never. So that's, I mean, I guess that's the opposite concern. We are talking about demand being too high and disrupting, you know, banks, but maybe demand would just be, you know, too low. That's also a consideration.
But do you think, I'd like to suppose with all of the count, do you think central banks would want to design obstacles so that private sector financial or technical companies couldn't unduly dominate the payments infrastructure as cash gets replaced? Hannah first.
Oh, I don't know. I don't really think I have an answer to that one. Okay. I'm sorry.
Okay, David, what do you think about that? Do we need to? In the example I've just used, CBDC quickly disappeared in favor of, I suppose, commercial bank money distributed by American tech firms.
Well, the issue of whether it's American tech firms or not, I think, is an interesting but different conversation. So, and certainly it might be worth a future discussion at a roundtable like this to ask why the European Commission was so upset about the American duopoly of Visa and MasterCard that they pushed through PSD2, which provides open APIs by mandate, and therefore replaces the Visa MasterCard duopoly with a future Facebook, Apple, Google duopoly. I mean, I don't really understand the logic behind that. So that's a separate conversation. But in terms of the use of the CBDC, I don't think we should be thinking about it in terms of the sort of 1990s experiment with cash, Avant, Chipper, Chipnip, Semepa. They weren't really electronic cash. They were electronic purse cards. But, you know, if I had a Chipper card, I couldn't use it to pay Tunis. I couldn't use it as a cash substitute. I could use it to pay my car parking. Right. And actually people did. I mean, that was the only thing they ever did with it, was to pay car parking. So I don't think we can, I think what we can learn from that time are some lessons about the distribution, which I think are not good for the commercial banks at the moment, because the commercial banks are not going to be very good at competing with Facebook and Google and Amazon and Apple on the distribution side of things. You know, no bank is going to make a better wallet than my Apple wallet that's on my phone right now. And this is where my sort of crackpot theory about identity comes into play, because if CBDC takes away the margins on the payment side of things and third parties step in to provide the wallets, you have to ask yourself, what is it? What's the actual value adding position of banks in that quite appealing lower cost infrastructure? And I think the answer there is, you know, the customer intimacy, the KYC, AML, CTF, PEP. At the moment, that's not monetized. So at the moment, banks spend, I can't remember the figures for Europe, but whatever it is, 100 billion trillion euros or something on KYC, AML. And in return, they get nothing because they haven't monetized it. But you could imagine a situation where Facebook is providing a wallet. I use that wallet to store Libra and digital euros and digital sterling, which I'm very happy with. And when I open that wallet, Facebook pays the bank. Let's say I open it using my Barclays account. Facebook pay Barclays an interchange fee for the KYC, and we have a liability structure. Some of the people around the table might remember the old Identrust scheme before that had in my opinion, quite a well thought out liability structure. So I in my head, those two things are slightly different. So are we going to end up in a world where the tech giants dominate the customer interface? Well, the answer to that is yes, if we don't do anything. So
which was exactly what I'm asking. David raises an interesting point, Tonis, which is that banks could be an ID infrastructure rather than the money distribution infrastructure, because they're going to outgun tech firms. What do you think about that? It would turn what some banks regard as regulatory burden on its head into their prime rationale and benefit.
Yeah. Well, I think indeed that the KYC part of what banks do has been an underappreciated part of the business model, and not only underappreciated because of the many fines that banks have gotten over the past years, including my own employer, but indeed also in terms of monetization. So this is definitely part of the way forward. That indeed, I think indeed, like David says, currently banks are the best providers of digital identity, I think, around. It's relied upon. Despite the bad reputation that banks still have, this is one thing that banks do and generally do quite well and are trusted to do. So this is indeed part of the business model. What the question is for me is indeed, is this all there is left to do for banks? Because are banks going to end up indeed providing digital identity to other platforms, or will banks still succeed in being that platform themselves and having this primary client relationship themselves? And this is the battle that is going on, that will intensify. The outcome is unclear. Indeed, it will depend on competition, but indeed, it will also depend on what policymakers will do. When you look at the continent, the European Commission has certainly woken up to, let's say, the threat of big techs, or let's put it a bit more mildly, the need to regulate digital markets, to regulate especially platforms with gatekeeper functions, to avoid platforms becoming dominant. Indeed, if policymakers are successful in regulating platforms with a gatekeeper function, then that might result in at least keeping some diversity in digital platform markets. And there is still a chance for banks to also play a role and build a platform of their own. So yes, digital identity. The question for me is that all, or can banks still do more?
Tony, so I've heard bank chiefs in the past worry about becoming a utility in the background, particularly with millennials, where they'll forget the bank brand and think that their bank is Google or Apple, not realizing that the infrastructure somewhat belongs to commercial banks. And once you get pushed into that situation, it becomes harder to cross-sell and it becomes harder to have a business case. Is that something that concerns you?
Yes, it's definitely a concern. I think the most obvious example is everybody that has an iPhone, where indeed Apple Pay is in front and banks are providers. This is different on the Android platform, where banks are able to provide a direct interface when you use payments, when you use the NFC tag on your phone. And so Apple is, you could say, very successful in indeed being in front of the customer instead of banks. And yes, this is the core of the competition that's going on, of the battle that's going on. It's really the battle of who has the screen that's in front of the client.
Yeah,
that's, I think, the core. Yeah.
Hannah, I'm interested in this theory that we could return the regulatory infrastructure around commercial banks into an asset in terms of custodianship of ID verification within a digital money system. What do you think about that idea? from a central banking perspective, regulatory perspective, say?
I don't know. I'd have to think about it a little bit. I've always thought that perhaps it should be like the government that has the ID, but I'm sorry, I don't really think I have anything to say about that right now.
Okay, fine. And a similar question. Let's say that there is a Swedish tech firm which is running alongside banks and providing payment services. At what stage do you want to regulate it like a bank? This is to come at it the other way around. Presumably you want to do that. At the moment, it becomes a leveraged institution, lending rather than simply a payments infrastructure. When, in your eyes, does a tech firm become a bank?
I think that's a very good question. And I mean, it's still sort of an open question because we are grappling with how to regulate all of these new forms of money and everything that comes up, right? Yes, you would have to, if you just are sort of custodian of, if you keep the money that's used for payment separate on your balance sheet, then that's of course a different story. Whereas if you can use it on your balance sheet and you can lend and, use it for leverage, like you're saying, then you have to be regulated in a different manner. But I mean, I guess this is sort of a different question from CBDC in the end. It's.
I mean, I would take you probably think this is a very unsophisticated view, but I would take a very simple definition. I would say if it's not a bank unless it can provide credit. And so I think for a great many people, what a lot of the big techs do is they have business models which are not dependent on the income or profits from the provision of credit. So even if they could provide credit, that's not, Google makes far more money out of advertising for SMEs than it would make out of providing some financial services. I mean, for a start, it wouldn't be allowed to have the market dominance in financial services that it has in advertising. So I think for the foreseeable future, I think those things will be separate, because I think there's lots of reasons in society why we want, the provision of credit is the time bomb that can blow things up. And so I just feel, if from a regulator's point of view, I would prefer to see credit continue to be very tightly regulated, and the cost of that regulation and the walls around it, I think are quite unappealing to big tech. Big tech doesn't want it doesn't want the scrutiny that comes from that. So I sort of feel those things will be separate for some time.
Okay, would you agree with that, Toyn? If there is that high barrier to entry, that there isn't too much for
high barrier to entry for credit.
Yes.
Yeah, if I may add to that, I think indeed what you see is going on, not only with CBDC, but broader with the arrival of fintechs and neobanks, is basically an unbundling of banking services. They are provided individually by separate institutions, by payments, savings, credit. They can be provided individually. And this indeed also means that the banking license, which used to comprise all these activities in one institution, will need to be reconsidered, because you will need indeed, perhaps you will need to move to a situation where you license these activities individually. And to be fair, we are moving in that direction. We have payment institution licenses, we have e-money licenses, credit can be provided by non-banks, but I think we have further steps to take there. And that will also mean, in my view, that perhaps the payments and money business might need further regulation or tighter supervision in terms of, KYC and AML, for example, because yes, credit is indeed an important risk for the system, for financial stability, but payment flows are also important because you have to know where the money is for AML purposes.
Are you thinking about Wirecard, for example? I mean, we looked at...
That's one example. That's one example. Although arguably you could say that in Wirecard's case, the regulatory system worked, because
I agree. I completely agree.
The money that was indeed kept in separate accounts, and indeed no client money has been lost. So you could say it worked. Of course, people, there are losses in the system, but not for clients holding accounts with Wirecard. So So that worked. But we see, for example, in payments, especially cross-border payments, as more fintechs enter, you see that banks and supervisors lose sight of where the money comes from, where it goes to, because transactions get cut up in separate pieces. So from a systemic perspective, we are losing, or we risk losing sight of the flows of money in the economy at the Eurozone level, at the global level. And that's something I think that we will need to pay attention to.
So lots for regulators to catch up with here. Henry, a question from Mark Cliff, we heard from earlier at ING, which is important, back on business models for banks. What impact do you think CBDCs will have on lending margins for lending? So the fundamental business model of banks that could be under pressure here, and they're already under pressure, obviously, particularly in Europe, from zero or negative interest rates.
Correct. Yeah. I mean, two things on this. I think we have to look also not only from purely CBDC silo, but also about other digital assets, right? On a pure CBDC perspective, frankly, I think there's not that much upside for commercial banks in many regards. I mean, on the funding issue that Mark is raising, if more people are holding money in their CBDC wallet, there's less money in the bank. This obviously affects the whole basic banking activity of banks, right? So I think that on that perspective, I'm not sure it's positive for the banks, and just not even opening the conversation of all the piping, the new technology, the cybersecurity, the treasury, all the different costs that commercial banks will need to incur if they want to have the piping for CBDC. That being said, though, I would argue there's a lot of opportunities for revenues, new P&L that our banks are not capturing today by the broader digital assets economy. And frankly, CBDC can be a catalyst. I mean, let me give you a very simple example. Today, if I have, let's say, $1 million in Ethereum or any cryptocurrency, I go to any of my lovely banks and I say, I have $1 million. Can I get $100 US of loan? Nobody recognizes that Bitcoin or any cryptocurrency, and I'm not able to get a loan as a collateral. This is why you see now in the digital asset space, a number of fintech solutions right now where you have an opportunity to actually borrow lending, like with old school banking, where these are services are having, many of them have billions of dollars on assets under management. Again, very tiny when you compare to the bigger banking role. But I think there's all these business models that are coming into place right now. And I'm not even talking about like DeFi and some of the more cutting edge stuff. Second thing is also for a lot of the banks, we are seeing a lot of banks generally get into it, which often we're not talking about. Some of them are purely investing in crypto companies. Great example is Goldman with their investment in BitGo and others that they've done recently. Others are partnering. Great example is Nomura with Comenu, their joint venture with Ledger, that is offering institutional grade custody, regulated, that has all the different offerings to institutional players who want to enter the market. Yes, some are building on their own, JP Morgan Coin, and others with some of the Japanese banks. But also I think the area I'm watching right now is organizations that are launching separate businesses, purely focused on digital assets. And as initially Mark was mentioning, yes, that may cannibalize your existing business to a certain extent. We saw Fidelity do this, for example. Fidelity Digital Assets, completely new business or backed, done by Intercontinental Exchange, New York Stock Exchange holding company, really focused purely on digital assets. And these are actually, I think, pure revenue opportunities that we're seeing with a lot of financial institutions. I think we should not keep that in mind that, yes, there's a lot of challenges and purely on a CBDC vertical, but the ecosystem is giving a lot of new revenue opportunities as well.
You're basically saying, Henry, do something else for a living, I think. I mean, a very simplistic summary, but or use this technology to add value elsewhere than lending.
No, not necessarily. I mean, these services that we are seeing as fintechs do right now, for example, these could be done in a bank context. Still, for example, one of the big challenges we're seeing right now with the entry of institutional investors in the digital asset space is that many of these players don't have what we take for granted in a traditional space. They don't have SOC 1, SOC 2, they don't have basic ISO qualification, they don't have Big Four auditors, and so on and so forth. And now for the last 12 months, we've seen some of these crypto players get these kind of just check the box items that happen during operational due diligence. And there's a couple of benefits for this. This is why you're able to see more institutional capital come in. This takes out the risk of being fired, which is obviously the career risk, which I was mentioning again at the beginning. And also the fact that there's now more institutional players entering the space as well, it kind of giving a bit more comfort on it. So I wouldn't say that, again, we've seen this with derivatives in the past. We've seen this with emerging markets investments that happened in the past. Yes, I agree. It's a bit more of the investment banking model from that perspective. But I think these are things we have to consider from that perspective.
It slightly reminds me of a slightly unfair comparison. I remember descriptions in the about 2005-6, where banks said, we'll create a new capital markets infrastructure, which means we won't need to be universal banks anymore, which is too expensive, and that was securitization, and it ended in tears. But that was fixed with regulation in the end. But David, I think you would welcome, I suppose, from your comments in the chat stream, you'd welcome, I suppose, the competitive pressure on banks rather than worry about compressed profitability from lending. Is that fair?
Yeah, I'm just making fun because I mean, Henry, I don't know how PwC compliance works, but you really should have begun that by saying, warning, this does not constitute financial advice, because the amount of money being lost on a daily basis in those DeFi frauds is just going off the scale at the moment. So look, I think that the pressure on banks is long overdue. If we're being harsh about the financial services sector, and if you go back to the metric I used at the beginning, if the measure of the success of the financial services sector is the proportion of the economy that extracts in fees when the economy is trying to work, we should be trying to have national strategies to reduce that. The cost of intermediation should be going down. We've invented laser beams and satellites and transistors and things like that. But every time us technologists find ways to drive the costs down, along come the AML5 and the AML6 people and divert all that money to lawyers. And that doesn't seem very fair to me. I think we should be trying to boost the real economy by reducing the overall cost of intermediation.
Mark Cliff is responding. If banks, commercial banks, are pushed out of lending, and we talked earlier about the magic of fractional reserve banking, who's going to fill the gap? Won't it shrink the economy?
Look, I am not an expert on these things, but I think if you go to any economics textbook published sort of pretty much after Mary Poppins came out, that version of banking, with the children going in and depositing their pennies and the banks saving it up to pay for was it steamships in Peru or something? I can't remember how the song went, but that's not how bank lending works. Bank lending isn't constrained by customer deposits. Bank lending is constrained by regulators and assets and all sorts of other things.
So in other words, you'd say, just to take that to the next step, so the answer is to change leverage or capital ratios in order to go back to where we were 10 years ago or something, to make it easier for them to lend.
I'm not but yes, the answer is in twiddling those dials. I don't know what those should be set to, because I'm not an expert on it. But in terms of competition, if you think about when I'm doing scenario planning with financial services, I use this very simple model, this old Harvard Business Review model of banking functions, which divides banks into these basic central, transfers in space, transfers in time, transfers in scale, risk management, incentives, that kind of thing. If you look at the impact on those, then actually it's not obvious why banks are doing the payments. It's not obvious why the banks are doing the information management. At the moment, banks have a role to play in creating incentives for transactions to take place, because there are a great many examples of transactions which simply won't happen unless a bank is involved to provide, stability and intermediation.
I think if I may add to this, because this goes back to the conversation that we were having earlier about how do we want the system to look in the future, and one of the core questions is indeed how do we want to provide credit, and if you take away, I should phrase it differently. If indeed CBDC means that a lot of the payment account volumes are going to move to CBDC, then the question arises, how do you fund lending? That can either mean the central bank funds the banks. It can mean we just fund lending with savings accounts. That's another possibility. Or we transform lending in more of an equity business. So with risk, the credit risk basically directly put onto the account holder. So a sort of investment account.
An Islamic banking solution to it.
Yeah, so there are many solutions, and they all have their pros and cons. And this is something that you need to think about. what is it, 2 years ago, there was in Switzerland this referendum about Wohlgeld, which also involved the question behind this was basically what role do we want for banks? What role do we want for the central bank? And like also we discussed earlier, another possibility is that the central bank is going to fund a large part of lending to the economy, which has obvious downsides and political issues about choices to be made for the central bank.
But then they need a huge credit officer infrastructure and all sorts of other things.
Exactly. So I mean, there are many choices to be made, but I think one obvious way would be indeed to move to fund lending with savings accounts, with investment accounts, and I think, but that will mean that borrowing will become more expensive, and maybe the volume will be supply will be lower. But well, that's something that we need to think about, also in the context of CBDC.
But can I ask?
It may increase rather than reduce cost to the end user. You're saying, Tine, it's an interesting point.
Yeah.
But can I ask Hannah, you know, in these scenarios that Turnus is outlining, you know, like, if we imagine, you know, we have savings accounts which are funding a certain amount of lending, perhaps that might be used for domestic purposes and mortgages and things like that. But then you have a slightly different kind of investment banking sector, which perhaps has this more kind of Islamic model that Turnus is. Does that seem to, I mean, to me, this seems like quite an interesting vision of the future, but how does it look to a central banker?
Yeah, over to you, Hannah. Good question.
Okay, so in Sweden, for instance, I mean, if you look at, so cash is also a competitor to funding your lending with payment accounts, right? So Sweden, the amount of cash over GDP is about 1.5%, whereas in the Eurozone, it's about 10% of GDP. And Swedish banks are doing just fine. And I think lending margins are not higher in Sweden at all. So what they do is they fund themselves on the market instead. Now, you know, there are so many things that play into the margins, I think, that banks take on their lending rates, and market funding can be more expensive, but it's not necessarily more expensive. So I think it's not straightforward that it will be more expensive, that margins will be higher at all. And also, I think, I mean, business models are not threatened as long as the CBDC does not take up too much space. Whereas this other model, which becomes something more like the Chicago plan or something, where you sort of separate payments from other parts of banking and lending, I think, at least, I mean, there are some academic thoughts out there, but at least from my perspective, the central bank shouldn't be changing the financial system. That's a political decision. If the policymakers want another system where you know, it's more like the Chicago plan, for moral hazard reasons or whatever, I mean, that's a different story than CBDC. I think our mission today is to sort of maintain the structure that is today.
Thanks, Hannah. Just a quick question from someone watching. Carlo Cocuzzo has said, on the question of replacing or supplementing the lending function of commercial banks, what about P2p lending? I think maybe that runs into the same problems of it not being leveraged, and therefore you would reduce the overall amount of credit. What do we think about that? Perhaps over to you, Tynus, on that. Banks already co-opted P2p platforms when they were supposed to disrupt them, you know, 7 years ago, say.
Yeah, well, I mean, this is about, like Mark Buitenhek said at the beginning, disrupt or be disrupted. So as a bank, you should be prepared to disrupt your own business as well. P2p lending could be part of the solution. And the issue with P2p lending is that the whole approach is completely different from how we organize lending today. Well, that's not necessarily a problem, but again, it means a transitional problem. And why is that? Well, P2p lending requires a lot of liquidity. It's well, in some ways, it's sort of full reserve banking. The client provides the liquidity 100%, and that becomes a loan. While in banking, well, you mentioned fractional reserve banking, capital ratios. So there is a less, from a systemic perspective, the liquidity need of lending currently is quite low, which has a downside that lending may be bigger than optimal. Well, that's a completely separate discussion. but that's the current system that we have. If you only have P2P lending or fully funded lending, then I think lending could be too low compared to what the economy would need. So it's basically completely the other end of the spectrum from where we are today. And this is exactly the kind of fundamental questions that you need to think about. Where do you want to be in the future? And then secondly, okay, how do we get from where we are today to that point?
There's one
David, very quickly.
Sorry. I think there's a non-financial aspect to P2P as well, which I find quite interesting, which is, for example, I have accounts with Kiva, which is the lending to developing countries, to Funding Circle, and part of the fun with those is it isn't just putting money in a deposit account and leaving it. It's quite enjoyable, looking at the different projects and deciding which ones you're going to fund money to. And I fund the woman who is starting a sewing business in Peru or something. And if the business doesn't work out, I don't care. I mean, I'm just happy to help out in small ways. And some of those businesses take off and some of them don't. It isn't just financial. P2P, it's something different there. I think the P2P thing is not just about money. In my head, it's slightly different.
That's interesting. But we haven't got much time left, but I just wanted to spend a bit of time on transaction services, Tony, in particular. 5 years ago, people were talking about the blockchain completely replacing banks, and then it became a way to do transaction services and trade finance faster. And now people are talking about it facilitating, or DLT facilitating, CBDC. Where do you think all of this is going to end up? Do you think there'll be a single new DLT style technology which works across CBDC and commercial bank money and transaction services, or will these be parallel infrastructures competing with one another? What do you think will happen?
That's sort of the $1 million question. I think a lot of pilots also in Sweden are run on DLT infrastructure right now. So there is definitely promise in that. I think right now that the biggest problem for DLT infrastructure is that it just doesn't scale yet. The current state of technology is that it doesn't scale to cater for the payment needs of a whole society. And the big question mark is, will it scale in the future? And I just don't know. So I think that's one issue. Another issue is, what goal does a central bank or politicians indeed want to achieve it with CBDC? Do you want it to be the sole payment infrastructure, or do you want to position CBDC as a backup to existing infrastructures? I mean, that means that you make a completely different choice. And if you want CBDC to be also a backup, then you definitely do not want it to fully replace existing infrastructure. You want it to exist alongside existing infrastructures. So it really depends on what are you trying to achieve here, and that determines the technical choices that you make.
Okay, thank you. I'm going to run the poll again in a minute to round up, but I'd like everyone else on the panel to chip into that point. Do you think, I'll come to you last, David, you're the closest to technology, but Henry next, do you think you'll have a single new payments infrastructure that straddles everything from CBDC through to trade finance and everything in between?
I think frankly, it's a bit unlikely right now. Just a couple on these topics, right? I mean, we're having a lot of these blockchain technologies. You're right, there's scalability issues today, but frankly, we have the technology-wise right now, a lot of them are being overcome already. Yes, not with the main blockchains often we deal with, but from that perspective, a lot of it is being done right now. Interoperability, which at the end, the core of your question, John, again, we're seeing now a lot of more solutions on the interoperability to come into place as well. And frankly, also a lot of innovative ways as well. You know, that is sometimes we think in our silo as well. But if you think about how we think about first principles approach to what is finance, to what is banking, there's a lot of solutions coming in. I mean, I was mentioned before DeFi. I know David hates it, but actually intellectually, I really believe we have a moral duty to actually look at it. Everybody on this thing to at least understand what it is, you know, because actually it's a bit like financial Lego blocks. Imagine if the entire banking world today was the entire world of open APIs that actually works and actually is being used, and you can actually use them as Lego blocks together. Yes, there's a risk because everything is built on top of the other, but you're able to actually customize services again without central counterparties. But actually brings up a lot of interesting questions, not only from wearing my professor hat from an academic perspective, but also from a policy making and commercial perspective as well. So I think some of these issues are going on. I have to say there's a lot of work going on when it comes to banks and DLT. Unfortunately, things did not move as fast as many of us expected a couple of years ago. There's been a lot of great POCs, pilots. It looks great for marketing. When the CEO gives a speech, it looks good in the speech that there's a department where people wear T-shirts and doing blockchain experiments. In practice, very few of them moved beyond the POC or pilot. I really believe we're seeing a lot of very interesting things on blockchain and DLT in the non-financial world, from traceability, provenance, and food safety, and so on and so forth. Actually, personally, my personal view is actually when it comes to the financial world, digital assets is probably going to move faster than blockchain as an infrastructure, not only because of the cost and some of the technical issues that Tunis mentioned, but also comes back to that, kind of the risks reward for the people making decisions. It's from somebody right now in his career right now making a decision to pull the plug on the legacy system to put in blockchain takes a lot of courage, and I'm not sure we're there yet as an industry.
We know that centrally managed single complex systems eventually fail, like the palace culture of the Bronze Age or something. Hannah, what do you think? Will we have a single technology which allows for all financial transactions that goes from cash through to cash management, transaction services, and investment banking?
It's impossible to answer that question, but I think it's a policy question. Do you want parallel systems so that you have some backup, so that you have a little bit more redundancy and for a crisis preparedness, or do you want something that's perhaps less costly and more efficient, which would be that with these economies of scale that everyone is using the same system? So that's another question.
So you in other words, if I may summarize, you'd be I think wary of having a single system.
I don't know. It depends also on the jurisdiction, I guess. In Sweden, if you're talking about a different payment system that's completely separate from the RTGS and everything else that we're doing, it's a small country. So with a big investment, and maybe it wouldn't be profitable. I don't know. It depends. If cash disappears, you do need a backup. So there's a policy question there that, it's up to the politicians in the end. But for a large country like the US, perhaps, maybe it's a different story. So it's, because it's like the same investment that you have to make, but then it's a matter of how many citizens you have. It's interesting questions, but I don't think that we're there to be able to answer that yet.
Okay, thank you, Hannah. David, you've got, I'm sure, views on this. I've been watching the technology for a long time.
I think if you look at the whole spectrum of technologies out there, there are only 3 ways to implement a CBDC. But I've just submitted a paper on this to JPSS. Our only 3 options are: we can have a centralized system, a bit like M-Pesa, but it's run by the central bank instead of by the telco. We can have some form of sort of federated or distributed system where each of the banks runs its own set of accounts and they interoperate. I think that would be a plausible way of doing it. I'm not quite sure what the analogy for that would be, but remember, there's a big difference between trying to run electronic money systems and trying to run electronic cash systems, and that sort of constrains things a bit. And then there's what you might call the tokenized version of it. So do we run something on top of a DLT? Now, I think, and you would presumably say I'm saying this because I come from the technology end of the spectrum, but I think that might be the one that's worth exploring, because I think there are other financial and economic benefits to having a digital asset trading platform in place, so that we could trade money-like instruments without clearing and settlement. That would be very efficient.
Who would own the technology?
In my world, it would be the banks, but that's because I'm considered reactionary, conservative, dangerous, an enemy of innovation, and skeptical of DeFi. But in that example, CBDC, the central bank digital currency, would merely be one of the asset types exchanged on the platform. And I think that would open up more possibilities in the economy. So when it comes down to it, for example, if I'm the Bank of England and I want to build a digital sterling to take on the world and be a post-Brexit emblem of the white heat of new technology and all this sort of thing, why build something that we already have? This should be an opportunity to build something new.
Okay, thank you. I think we've had a very interesting tour of the key themes. I'd like to run the poll again before we close, Katie-Ann, could you put up the poll again, whether we think CBDC is a more of a risk or a benefit to the commercial banking sector? If you could all vote now, please. When you're ready, Katie-Ann, if you reveal the results. Well. So I think the panel has revealed that perhaps usefully, implementing CBDC is a little bit more complicated for the financial system than we initially thought. So I think, and therefore, we've had a very useful discussion. We don't have the answers yet. We'll try to get them, but that's a very useful finding. Panelists, final word: are you surprised that we've made people slightly more concerned about the impact of CBDC on commercial banks?
I am. I think the theoretical impact on commercial banks is very distant from any conceivable spectrum of real implementations. I really do.
Okay, Henry?
I think, frankly, even there's a lot of buzz, a lot of great things on CBDC. Thank you again to Libra for catalyzing this conversation. But I think what I'm watching right now for next, like, 12 to 24 months, CBDC is great. There'll be more pilots and projects that we're seeing already. I'm really watching the impact things like stable coins will have, and the flow and the volumes that we continue to have, the entry of institutional players, because I think all these elements we're going to have will have an eventual impact on CBDC awareness and potentially adoption.
Hannah, did the slight appearance of caution in our panel surprise you via the poll?
Actually, it did a little bit, because I thought we all sort of agreed that there are other issues perhaps than what the central bank would be putting into the financial system. But
it may be the credit formation point. We didn't ask, so it'd be unfair for me to speculate. But Tönnes, last word to you. What do you think about that poll result? We seem to have flushed out some potential risks for the sector that you work in.
Yeah, well, I'm let's say happy, not so much that people become more pessimistic on CBDC, because I think was at least not my goal, and I don't think that's warranted either. I am happy to see what I interpret as a reality check, that like any new big innovation, it's easy to think about it in broad brush terms, but when you move closer to thinking about, okay, how does it look in practice? How could we implement this? Then you run into all kind of practical issues that need to be solved. So what I hope for the CBDC discussion in the near future is that indeed we move to a more concrete discussion, first about the end state, about the transition, and about fundamental issues and fundamental ways to how they could be solved. And I think in that way we can have a productive discussion about how to move forward on this.
Great. Thank you everyone for listening in. It's been a very interesting discussion. Thanks for sending in your questions as well, and of course thank you very much indeed to this excellent panel. Thank you, Hannah, Henry, David, and Tönnes. That was really great. So thank you very much for your time this morning, and I hope you've all enjoyed it. We'll speak soon.